Markets have rallied from the October lows to be one of the strongest Octobers on records, and it's also now chalked up 4 consecutive weeks being higher each week. Where to from here? Gary Glover from Novus Capital is the one navigating us through the trading opportunities. Good morning, Gary. How are you?
Yeah, I'm good, Chris.
It's a Melbourne Cup Tuesday. We've possibly got rate movement, or highly likely we've got rate movements. Who knows who will win? But for more pertinent things, we're looking at the portfolio, which you remain pretty heavily invested. Reading through your report, the portfolio is up 16% in the last 4 months. Most definitely, you won't give credit to yourself too much on this one, but we will say it's aided by your timing on the mid-August high and then the October deep low that you called very well. When you look at this portfolio and all the inflation that we're looking at and how it dictates the market movements, will your portfolio adapt much with this future economic data pointing to inflation?
Yeah, well, actually, yeah, that's actually a good question, actually, Chris. Yeah, so I mean, you can sort of see what's happening. I mean, I guess probably the one observation is at the moment, which we probably will show on the chart there, is that the NASDAQ is underperforming. And so sort of growth is still sort of a little weak here. It's not, whereas obviously the Dow has really been humming. Yeah, which is sort of interesting because obviously we've got commodities weak as well. So it's sort of, there's a bit of a mix sort of through there. So, but yeah, so probably we're just, whereas I think most of my sort of value or what I call top tier sort of equities are looking pretty good. US funds looking pretty good. Just probably just have to watch the growth stocks there. So those are the ones I probably just need to temper there. So I'd probably go a little bit more quality, and yeah, just don't get too sort of growth oriented here. Yeah, maybe growth might sort of kick off until February next year. So it might just underperform a bit here, but growth will need to see inflation ease first before it can get going there. As we know, sort of in the past, there sort of those high inflationary markets, the NASDAQ has underperformed in kind of one of the weakest segments. So interesting that is the case so far here. So probably should have bought some more GGUS rather than the LNAS. That's probably the only thing. Yeah, I'll probably look at trimming some of that LNAS and look for sort of something a bit more high quality there. But should still sort of rally a bit further here. Just mightn't be the, I was thinking this was going to be the outperformer there probably a month or two ago, but the last sort of 2 or 3 weeks are sort of like, had me thinking, this may, inflation's still hanging around here, may not perform that well. Yeah, I was actually tempted last week to sort of just switch LNAS to GGUS, but that's right. That's everything else looks pretty good. So that's really the only thing. And yeah, just probably watch the growth stocks a little closer as well. Just make sure. But again, I think Domino looks quite good in that growth sector, and a few of them, things like sort of Seek and stuff, look pretty good as well. So there's a few that we've chosen look all right. So yeah, so that's really the only thing. Just yeah, just watch our stocks. And yeah, I was actually pretty happy with myself this week. Actually, I did sort of something. I did cut a few stocks that weren't performing well in my portfolio, and then added to the ones that I thought were performing well and looked better. And yeah, it's actually been a good move. Not sort of something I've done too much of in the past, but it's what you should be doing. But yeah, so sort of like, talk about something that we should be doing as a trader. And you read about the best traders, they'll go through the positions, cut the weakest ones, and maybe add to the strongest. So yeah, so sort of something I definitely will work on and yeah, look to do.
Well, that's definitely good portfolio management. But circling back on the growth side of things, you mentioned the NASDAQ. If we cast our minds back 12 months or more ago, we were talking about breadth and the issues that we were seeing within the market, especially the NASDAQ, where a lot of that heavy lifting was being done by a smaller and smaller number of companies, and the FAANG stocks were such a heavy weight and they were driving it higher and higher. When you're looking at the NASDAQ here, you've got it on the chart. We'll see relative to the other charts later in the report how it's just weaker. how do you view the NASDAQ, the FAANGs, and that sort of where the market is at the moment for the NASDAQ?
Yeah, so like the chart's sort of constructed there, sort of come down to a new low, technically it's come down to a great level. Square the ranges and all the rest of it, and starting to bounce there, but the bounce is not being that impulsive. And we've seen obviously within the NASDAQ, obviously the top stocks, the FAANGs, they've been underperforming, getting hit here, which is, I think we sort of said on Friday in the Friday's report there that after a bull market, it won't be the old leaders who lead. There'll be an emergence of a new group. So we're looking for the new leaders to emerge. So that's what the theory and textbooks sort of tell us. And so as we were saying on Friday, that's exactly what's been playing out. All the FAANGs are getting hammered. So they've been getting hit pretty hard here the last few weeks. So I mean, if you put that in context, there, NASDAQ's holding up pretty well. Interesting, obviously, thing with the NASDAQ, which we said on Friday, was that the new 52-week highs versus two 50-week lows are actually equal at the moment, which is quite amazing considering some of those stocks getting buried. So there is some new stocks starting to emerge there. Obviously, they're probably just a bit lighter weight and size and stuff here, but yeah, maybe it'll just take a bit longer. So I think out of that 02, 03 low, I think the NASDAQ had a bit of a dull bounce initially, then pulled back, and I think maybe the bounce maybe that came through from early 03 sort of was a bit stronger there. So maybe we might sort of follow that, but I think it's going to come down to inflation as well here. Sort of if inflation hangs around, then we know that the NASDAQ might underperform, and then obviously more your value, which obviously your Dow Jones, which has been really strong, is outperforming. So just means you might need to tweak the portfolio a little bit, less growth, more sort of value, sort of end of the market. Yeah, that's right. We'll make those adjustments there. So probably doesn't matter so much on this first bounce here, but probably by I think we might rally into early December here, and then maybe come back and make a higher low in Feb, March, and then after that we'll start to climb again. So we've probably got a bit of time to adjust that portfolio over that period.
So you were talking about maybe getting rid of the gearing NASDAQ ETF and looking at the rest of the US. So if we think about gearing the rest of the US, I should say, looking at the S&P 500, you've got this 50% retracement. So that has become quite critical, and your chart shows it. Can you just quickly touch on what the blue lines are on the fib retracement and why that 50% mark is critical? Yeah, critical for two reasons. Obviously, it's a big technical correction anyway. So I mean, 27.6 is pretty decent size there. I think it's I know it's not GSC or COVID there, but in the context of history, it's still a very large correction. Used up a lot of time as well. So in terms of obviously from the weekly range there, we've come back 50% of that, from that 20 lows. That's quite a large correction technically. And sitting on top of the previous highs, I think that's probably the other things people don't respect as well. So that's how our trends sort of build as well. So coming back and I always sort of felt this a lot of these markets would come back to those old 2020 highs, and that was a bit of a target to watch for to me. So so I still view that as pretty constructive here. So I do like this lower lot here. I'm pretty long, so like I'm seeing here, probably might need to pivot my sort of holding stuff there, but it's probably not that important on the first run here. But yeah, I think the market was pretty good. I think as I say, we talked about the bearish consensus was just everyone was so bearish at the low, everyone underweight, so much cash on the sidelines. I mean the amount of puts to calls was through the roof. I mean even the day after even the first day up, which is one of the big sort of 700-800 day points up there, actually the number of puts actually increased. So no one was buying the rallies. I thought that's perfect. So and even now we've sort of still got everyone looking for the everyone's most are still calling this a bear market rally. So so we sort of need to sounds funny here, we sort of need to get everyone on board before it turns back down again. So once everyone finally sort of turns positive, oh shit, this is not a bear market anymore, this market's going up. Once they get to that point, that'll be the point to sort of start trimming here. So I think we're still a long way away from that. I think we can move a bit higher here.
yeah, so I expect obviously we're going to get rates today, so we're going to get a few little shakes here and there, but I still think it's kind of constructive here. So I think there's some good signs here. Just seasonally it looks pretty good, technically it looks pretty good. All the bearish consensus is it's just equivalent to all the market lows. It's just all the same characteristics you see at historical lows in the past are all present here right now. So I think it's looking pretty positive. So yeah, so like no one's expected this rally here so far, and we just saw this is the Dow Jones. This is the largest October rally ever for the Dow Jones. So that's pretty big. So I think it's like, and it's also I think like the 6th or 7th largest month ever as well. So pretty impressive bounce. That sounds pretty good. But you go back and look at every midterm year low, those are they are impressive bounces. They're some of the most impressive bounces you see historically from a 4-year perspective. So so the first 2 months out of October lows, can be really impressive. I think it's averages over 20% there for the Dow. The 13 months out of the October midterm year lows, I think it's like a 49% return for the next 13.5 months. It's historically that's super impressive as well. This is the most, in terms of your 4-year window, this is the most bullish window we've got in front of us here. And no surprise to me to see we've had the I wouldn't expect October to be number one of all time, but the Dow's rallied very strongly here, 13-14% here in the first month. So, but that is indicative of midterm year lows in October. So, pretty impressive here. So we might just get some congestion. It's probably running a little bit ahead of schedule here, but no surprise to me to see this running pretty strong here. This is what happens. This is big moves, big rallies come out of these midterm years, particularly sort of those October windows. So this is sounds funny me saying this, it's actually looking quite normal for a midterm year.
Looking quite normal. Well, but to those who have
and the great thing is
reports,
everyone's still bearish, Chris, as well. That's the beautiful part. Is that we know and this is going to go down as a pretty unloved rally, which is perfect. Markets climb the wall of worry. That's what they do. So we don't. The moment everyone gets on board and everyone starts to turn positive, that'll be the time to be concerned. We're a long way from that yet.
Yeah, we do have a while until it sort of moves, rotates, and comes back down. We've just jumped into the Dow, and you said that's a very strong rally, best October in history. So that's a huge rally there. Let's just touch on the Australian market there, because for some time you have been saying, you've shown us a chart a few times before where the bonds lead the equities market, leads the commodities market. The commodities market can be sort of 1 to 3 months behind, you've indicated. Is that still looking to be kind of holding the Australian market back at the moment?
Yeah, look, it's a little tricky here for me because the normal cycle is for is that commodities normally find a low, so 1 to 3 months after equity. So we get, bonds go first, stocks go second, commodities are third. And that's, we can see that in the marketplace here. So that's the normal sort of pattern there. And we showed these sort of similar mid-term year cycles, these sort of, a decade cycle, all this sort of, the seasonal sort of cycle is that historically our market lags a little bit and we might find a low few months later, or even put a deep higher low in one of the two, but we probably tend to underperform because of commodities being weak and finding a low a few months later here. So that's the normal pattern there. The only thing maybe hampering that view is that inflation's so high, commodities often do quite well in high inflationary environments. So that's working against that view, which is in play at the moment for sure. So to me, I view it as, I'm not playing commodities because my cycles are negative, so I've got to trust that cycle. But they could hold up. But as I said, they're all trending down, Chris. So they're all they're moving lower here. They don't look that strong to me. Technically, they look weak. So they look like a normal cycle to me. So so there's hope there that maybe a normal cycle will play out. Maybe inflation might ease a little bit here. We can get back to normality, maybe have a bigger rally than everyone thinks, but if inflation doesn't ease, then we're probably going to be a bit more tempered. Maybe the rally's not going to be as much here. But yeah, so at this stage, it's sort of too early to tell. But I think there's still concerns around that sort of cycle there. So I'd like to sort of see those commodity stocks come a bit lower here, generally.
Okay, well, that's probably a good point to move into the trading shares that you've picked up this week. There are some commodity shares in there that we'll talk about. We'll start off with Wesfarmers, which is the first one of your trading shares in this week's report. Wesfarmers, that's just a downtrend that just keeps on going down. So this congestion that you've highlighted here, that red circle, why is that catching your eye?
Yeah, so two things on that chart there. So we've got our channel there through the bull phase, and then we broke through that channel at that bottom of the green line there. Now, normally, basically, you sort of break out a channel, you usually come the same distance. So that sort of size and scale there will be that's where you'd sort of expect the price to come back. This is just a observation, and also, again, like it's like all your technical patterns, they tend to break in size of the move as well. So this will move the same sort of. So that's our sort of guideline as to where we might find some support. So didn't get down to there initially, but we have sort of bounced off that line and then come back down, and it's really ground out near that low. So it looks pretty messy. It looks looks more like a bearish flag when I look at that Wesfarmers. So that's not so positive there. But when you go back and review the stock here, this is actually how often it sets up. So I saw a lot of these congestions off their lows there, sort of build and then pop out the other side. So it is a stock which tends to, I believe in personalities, like market stocks, but so you sort of got to, this is definitely a stock here that likes to sort of congest here like this and then pop up the upside here. So, and there is sort of, looking slightly underneath there, there's some good signs of volume accumulation taking place at those lower levels there. And it's taken a long, we've rallied up a certain amount of weeks, pulled back, can't go to a new low, hit the bottom of the channel, interesting as well. So I just think this is actually looking kind of positive to me. So Staples is a good sector to be in, pretty safe. Yeah, I think it looks pretty positive here. So I think if it breaks out of the top of that, break above $46, that's going to be pretty bullish. So yeah, so I did notice I had a pretty good day yesterday. So yeah, I think it looks pretty constructive.
Okay, so that's Wesies. In that same space, you're talking about Staples looking relatively positive in this part of the market cycle. Woolworths, it seems to be a bit heavier, so it hasn't really got that channel that you'd highlighted here, the green lines, but it's come down. Is this one of the false breaks that you talk about?
Yeah, so it's a little negative there because obviously we've got the high, then we got a couple of lower highs and then a third and a fourth lower high. So, so that's a bit of a bearish sort of setup there all the way through. But now it has gone to a new low, didn't sort of follow through. So our daily actually shows a bit of a false break there. So going to a new low and then breaking back above it within 2 days. So yeah, so I think it actually, these sort of false breaks are sort of, particularly if we go through more of a sideways sort of market, that's sort of trading market, you'll see this quite a lot here. So if we are going to be in lower growth markets, the false break is actually sort of, there's one pattern you'll see quite a bit. So again, I like the sector. It's had a pretty decent correction here now. Yeah, if you can hold this level here, I think oftentimes when you get a false break here, you don't follow through, you get a fast direction and a fast move in the opposite direction. So I think that looks pretty encouraging as well. So yeah, just a pretty solid, like Staples is a pretty solid, solid sector across the board here for me. So yeah, so
well, when you're talking about behaviours and the possibility of a fast rally, just looking here within this calendar year, we can see that it's already done it twice before, hasn't it?
Yeah, I mean, just have a look at Commbank. I mean, even Commbank has been up and down, up and down. It's been very V-shaped orientated. So that might be the market where we're heading into as well. So potentially, that's the thing about sort of low growth markets, is that they're actually more volatile than the high growth ones. High growth ones just tend to just tick higher week after week, just sort of going up slowly. Whereas the low growth, they really swing back and forth, big swings. So it's actually more of a trader's market there. So that's what I mean. So it's not, we keep sort of saying it's not all doom and gloom. Actually, if sometimes these negative markets can actually be great for traders. Actually, some great trading moves there. You may not move too far over the longer term, so it's not great for the buy and hold, but for the traders who like to trade the ranges, there can be some really good moves really quickly. So yeah, either way, there's opportunities, for investors and traders there. Just the buy and hold there, I'm not sure if that's going to, do so well. Certain sectors are going to, if you're in the wrong sector too as well, so, you could underperform as well. So you have to get the sector. That's the thing about this, the 70s and the 40s, you need to be in the right sectors. So, so that's probably the key there, is just to make sure you're in the right sectors. That's what I've been focusing on, sort of trying, apart from, identify the leaders and the strong stocks, but actually look back historically and look at, what sectors perform the best in those high inflationary periods, just in case we go through that, understand what does do well there. So, I think it's important.
Well, when we're going through those markets, it's, as you're saying, right to pick the right sectors, but also the right stocks within those sectors. You've got Reece in here, REH. Now, looking at that chart, it's also seems to be trolling out a bit of a higher low. So is that sort of critical relative support that you're looking for?
Yeah, it's interesting. So there's sort of construction and building and stuff there. It's probably the sector you're probably, if interest rates are going up and recession's looming and all the rest of it, it's probably a sector we shouldn't be going near. Yet, all those stocks are really a bit hammered, Chris. They've been really, things like CSR, Lend-Lease, they have been buried. So they've already had a big correction. So sometimes the market can get ahead of itself as well. It can actually already price in all the doom and gloom even before it's happened. So oftentimes the market will price something in on the fear of it happening rather than actually it happening. So those stocks can actually go up, even though it doesn't actually feel like that should be the right area to be in. They can actually still move higher because you've already priced in the worst case scenario. So, if it's not as bad as everyone thinks, which often does end up being the case, then the share price is going to actually go up quite a bit here. It's just probably won't be a leader, but they can still sort of move higher here. But I just noticed sort of reset, sort of come back a really big correction now. It's quite a large, we're looking around sort of 75% of the range or something there. So that's 3/4 there, which is big Gann range rather than a Fibonacci range. So your sort of halves and quarters and 3/4 are pretty big levels. So let's come back to an old high there around 2018, which we've got on the chart there. So big level as well. So just starting to build from that. So just sort of shows signs of probably more building a base here. So just kind of might be sort of constructive there. Might just build a base over time. But again, that's a really large correction there. I mean, stock sort of, it's more than halved. So it's so it's pricing in, and that's not a growth sort of, I guess it is a bit of a growth, but it's not like a sort of small, growth sort of stock.
It's a well-established business.
Yeah, it's a profitable business, makes money, pays dividend stuff. It's just not like a lithium stock, which is, dug a few holes and it's got a positive outlook. This is kind of been around for a while, sort of, clear revenues and, pretty mature sort of business. But so that those don't have, don't often have these sort of 50-60% corrections too often. So so definitely one to watch here.
Okay, well, another one that you've looked at and highlighted is JLG. You're talking about this sort of construction area. It's a wild ride. You're talking about sort of 50% drop in Reece. It's become pretty close. So sort of 937, you've got the high coming back under 5. That's a huge drop.
Yes, they do all the repairs sort of work there. So if you think, you think of all the storms we've had here in Australia here, these guys have been probably killing it, having to go in and, with insurers to do all the repair work and stuff there. So has been a growth business before the bad weather there. It's obviously sort of a relatively new company in the last few years, but it has had some really strong growth, but the, weather conditions are really sort of probably helping them. So they're supposed to be around for another year, these weather conditions. So, but again, this has had a pretty big correction back to the 50% level. Had a nice bounce off that low and then it's come back again. And that's probably come back in sort of similar time. So things are around for about 8 to 9 weeks up, pulled back the same amount of time, hasn't gone to a new low, so actually held up quite well. Big exhaustion on that big move down, the big sort of bar that got in red there. And then we sort of recovered there, and then we've sort of consolidated that move the last sort of couple of weeks here. So that looks kind of constructive to me. It looks like it wants to sort of rally up here. And look, I don't know if this is the most bullish there longer term, but definitely looks like there could be another little, just like a little ABC. This could be a C leg up here, which might take it up to, could go to up near 850 potentially. So it's not a bad move up there. So that's, that looks kind of constructive to me as well. So, but yeah, so there's plenty of good, positive looking charts out there, in my opinion. But it is sort of interesting. That's all.
Well, positive looking charts. We might just stick with the theme for ABC. You've got Fortescue on here. Could you just elaborate a little bit more on this ABC correction? Because we talked about commodities. We said we'd put them in here. Here they are.
Yeah.
The ABC.
So So I mean, like the Elliott wave theory is that basically the theory is sort of markets generally go up in 5 waves and they come back in 3 waves. And that's, look, it's, it's like every sort of theory, you sort of take it with a pinch of salt here. But I can tell you that the most common pullback in the market is a 3-wave pullback. And the most common is for is for the A leg to equal the C leg down. So I see that all the time on short-term charts and medium-term charts and dailies and half hourlies, and so that is the most common corrective pattern you'll see. But regardless of that, we do have a strong trend being broken down, overbalanced the trend, bounced back up, made a lower high, and since then all we've done is make lower highs, lower highs, lower highs. So from a trend perspective, this is still pretty negative. And I did sort of highlight the volume profile there, just sort of where the red zones were down the bottom there. They're all the heaviest down days, and they're all heavy selling days. So basically all the volume, so basically the down move, the down move, the down move, the down move, those are the heaviest sort of periods in there. So it's not like we're sort of going down a light volume. We're actually, every time we sell off, we're actually selling off with a bit of trading volume, and then we bounce on lighter volume, and we sell off on heavy volume, and then we bounce again on lighter volume, and we sell off on heavy volume. So yeah, everyone knows these, these cycles, these sort of bonds to equities to commodities. That's just a normal cycle. That's been around for a long, long time. There's nothing new with that cycle. This is, again, it's just textbook sort of stuff here. So it really does favour, commodities finding a low here. Like if our October is our low for equities, then maybe something like November to February will probably be the low for commodities. So that's sort of something which has happened in the past year. So that just sort of favours, this coming back down to that, new low. They're definitely taking out A. That looks like a lay down the sand to me. It's going to cut below that A there. Just how far it comes back here, but the most normal is for A equals C. So that would be around $12. So that's what I think it'll probably come back to.
Well, that's Fortescue. You've also got something similar for BHP. So yes, they're both miners, big Australian miners.
Yeah. So similar. It's over. Yeah, exactly. Yeah, that's overbalanced again. So biggest correction of the move. So that overbalances the trend. We go back to retest the high. We fall short, make a lower high. And since then, all we've got is lower highs, series of lower highs, series of lower highs, and then we've got the same sort of heavy selling on the down weeks as well. So if you go through and drill into your days and stuff there, you'll see that the heaviest, the trading volumes are a little heavier on the down moves there as well. So that's still pretty bearish to me. So it's still, that suggests coming back to at least retesting A, which is around that $31, $32 level. So looks pretty negative. I mean, yeah. So I just think they'll come back here. So I just think, I'm actually hoping that's a really healthy sign for us. If we follow normal cycles, then maybe we'll go back to a normal market rather than a high inflationary one. So I really don't want to see a high inflationary period last for too long, because that's just not good for everything. So that'll make it tough. The broader, means the market won't have big gains. This means most asset classes won't have big gains. So they'll have gains. They just won't have this. They won't have the same sort of gains as a low inflationary period. And the cost of living will be more expensive for everyone. It's just a lose-lose situation, having high inflationary period which hangs around for many years. So this is the thing here. No one wants rates to go higher, but the reality is if they'd moved them higher earlier, taking a little bit of short-term pain, we wouldn't be taking the long-term pain. So 3 or 5 or 10 years of high inflationary period is going to be much more painful than, say, 6 months of high rates or 12 months high rates. That's the thing is, it's just like life, mate. We want to take shortcuts and don't want to take any pain. But yeah, so the central banks here have got themselves caught here because they weren't bold enough to sort of, take the pain early here and do what's right for the long term. And now we risk a greater pain over a longer period of time, which is a concern. So yeah, so it's funny, mate. I'm not the smartest bloke in the world. I'll just read history, and history is littered with facts around this. Yet I don't understand how these central banks haven't seen this. It makes no sense to me. But I don't want to digress. Let's we'll get on to the next chart.
Well, you've been through that one in detail, so you can look back in history. We might see if we can find a link for it. But you've covered the 40s and 70s and how long and how destroying that inflation could be. But we can move to a position here where if we look back, let's just scroll back up here for a second, because in the portfolio, we can see that name Domino's Pizza. You picked that up on the 5th of October and it's running pretty well at the moment. So you've put it back in this week's report. How come it gets round 2? I just thought this actually looked one of the strongest stocks here, actually, really, just with just the volume there looks pretty heavy. And yes, that looks pretty positive there. Sort of broken up through the last swing low, which is so that rules out a big negative for me. So that's a really good sign. The volume really is, is a really good sign as well. So the daily is looking really constructive there. So yeah, this is looking pretty good. And maybe this is sort of one of the growth stocks that can do well in a high inflationary period, because, mate, the humble $5 pizza could really be the right position to be in, So yeah, but inflation, we can see the cost of a coffee or a muffin or whatever takes our fancy, that all those prices have sort of gone up here. So if families do start feeling the pinch a little bit, then the $5 pizza definitely could be a good place to be. So the chart looks pretty good. So yeah, so it's obviously been a stock that's recovered quite nicely after these sort of growth plans. So if inflation can disappear, I still think it can do well. If inflation does hang around, it's probably one of those growth stocks that actually can do quite well. So yeah, so again, this is the whole thing about choosing the right sectors to be in here. To me, this feels like a pretty good sector to be in, good stock to be in. So far the price action is pretty encouraging, and that strong signs there. There's actually been a bit of accumulation taking place for that stock here. So it is a little volatile, the stock. So it is can be up and down like $1 each day. I think it's down $1 today after being up $2 the last couple of days. So it's that type of stock here. But I do like the signs there. I think there's some really strong volumes coming in here on the stock here. And that's a good sign there for the longer term. Well, that's a good way to end on a bit of a positive there. That's the leading or the group of companies that you're looking at this week. And obviously you have talked about rotating some of the weaker names out of the portfolio, topping up, and there's a good explanation or a good example of one where you may be topping up. Now, as we walk through these, you've mentioned many other things. You've talked about looking at the consistent leaders and then the Friday companies. So we'll put that on the right-hand side, that playlist there. And then also some of the trading patterns that you've talked about, VCPs, springs or false breaks, and ABCs. So we'll put them on the right. But we might call that a wrap and say thank you very much, Gary Glover from Novus Capital.
Thanks, Chris. Yeah, I did notice people have been leaving some good feedback, which is fantastic and really nice. And also people have been actually sending a lot of questions through, Chris, as well. So I don't know how to actually best answer a lot of those. Maybe we should do a little show of, or maybe we can target them anyway at some point there, but we'll put our thinking caps on and try and come up with a way to answer some of the questions, which I think are some good questions actually that some of the viewers have been asking. So we'll chat about it offline and maybe put something together.
That's a good point. So keep sending the questions through, and Gary and I put our heads together and figure out the best way to get back to you all. Point. Thank you very much again, Gary.
Thanks, Chris.